Good evening, everyone, and thank you so much for being here. I very much appreciate it. Thanks to everyone who is visiting that's never been to Right Way Options e-learning session. I really appreciate it. Is there anybody here that's brand new, never been here before? Just type a Y. We'd love to welcome you here. And thanks for participating tonight. I do appreciate it. Tonight, clearly, we're going to talk about debit spreads. Anybody here trade debit spreads? Is there, well, probably better ask the question, is anybody here never traded a debit spread? Doesn't even know how to really get started with them. Never traded them? We have never traded them. Okay, well, this should be good for you guys to get some information about a debit spread and see if it's one of those strategies that you might want to add to your trading arsenal. So first off, what is a debit spread? I'm going to go to this black screen here. There is no slides other than what you just saw. Just the title slide. A debit spread is a really pretty simple strategy. It is combined with two options. One, you're going long the option, and one, you're going short at the same time and within the same month or the same series of contracts. Okay, so what does that mean? Well, let's say you're looking at the January contracts here and you're thinking that this stock is maybe setting up in a bullish pattern and you want to take advantage of it to the long side. But at the same time, you're looking at this chart and you're seeing up above over here at the left, there's a pretty substantial resistance up here in the chart. And so what you do is you buy a call option. Buy that call, and then at the same time, and this hopefully is an in the money call, okay, and then you sell a call option up here near that price resistance, even above, that's an out of the money call, and these would both be within the same contract period. Now the idea of doing the debit spread is to create a position that is lower cost. Okay, so for example, I'm just going to grab some numbers here. If you paid $8 for your long contract here, $8 a share, but you were able to sell an out of the money contract for $1, which is probably unlikely, but it makes the math easy for me. $1 a share, you have lowered your overall risk on this trade, okay, to $7. Okay, but not only have you lowered your risk, you've also offset your theta decay. Okay, so if your theta decay here is somewhere around, let's say this theta decay is running about 3 cents in theta per day, and you can catch up here something that's running about 2 or 3 cents of theta decay, you have offset your theta exposure in the market, which gives you that longer period of time to be able to hold this. Okay, because we're essentially making a stock trade, an option trade, look a little bit more like a stock trade, where we're offsetting our theta cost in the position. And then as this trade moves up, if it moves up, okay, the long call's making money, the short call will be losing money unless by the time this gets to expiration, that out of the money call is still out of the money, then this expires worthless. And this is max profit, and you've lowered the risk of the trade. Okay? Yes, it is being recorded. If the trade were to fail, if you believe this thing is going to go up, but it doesn't, it reverses, and this thing starts heading down, you've collected this dollar here, which is offsetting your stop loss. So if your stop loss is here, and it was without this call option, your stop loss was going to lose you $200 on that trade. Well, you've cut that by $100, and you only have a $100 stop loss on this trade. So you've reduced the risk to your stop loss as well. Okay. So when you look at a P&L graph of a call debit spread, you're going to look within the same month. And what we really want to do is we want to be thinking about a bullish upside trend. And the stock has moved up, holding a higher low of some kind. And this is our entry point. And we want to get into that trade and at the same time sell that call out of the money. Now, when you look at a P&L graph on this, we all know a long call is going to look like this, right? That's your P&L graph on a long call option. Your risk is limited to how much you paid, right? This is your how much you paid, the premium into the trade. That's the maximum risk that you can have. Hopefully the stock is up here someplace. You picked up an in the money, and this trade has an infinite upside opportunity. Okay. So you have unlimited upside, unlimited risk. But what we do with the debit spread is we change that trade just a little bit. So here's your call option, but then we cap it. So this is our long call option here. We're long here, and we're short here. Okay. So let's say this is $50, and this is a $60 up here. Your maximum profit on this trade is always going to be the same. From here, you bought this for $50. It goes up $60 minus the cost of your premium here. And your short strike has that potential of expiring worthless, lowering your overall cost basis in the trade and offsetting your theta. If the stock does happen to move all the way up here and goes beyond, by having this short call option, you can be called away on the trade. Calling away means that you gave someone the right to buy this stock from you at $60. You bought it at $50. Do you care if this goes above that price and you get called on this trade? $10 is your profit on the trade minus your entry expense on the $50, but you get to deduct what you came into, what you sold here on the overall cost of the trade. So just to make this easy, if this was $8 to enter that trade or $800 to enter that long position, and you collected $1 here, if this is called away, you've got $10 that between here and here. It costs you $8 to get into the trade, so you've got $2 potential profit on the trade, but you called away here and you collected $1 here, so you've increased the profit on this trade in this example by 1/3. You've added more premium to the trade. You made more money on this position by doing that. Okay. Does that make sense? Now I'm going at this kind of fast, I know. No, James, you do not. You can anytime if you're short a 60 strike option, okay, at any time the stock is above 60, it could be 60.01. You run the risk of that option being called, okay? But think about it. If you sold this for $1 and you picked up $1 on this trade, anyone that exercises this contract prior to this making it up here to 61 is actually executing this trade at a loss, because they've already got $1 in the trade. They've got to get to 61 to be break even on this. So it's unlikely that they would call that trade, okay? And even if it goes all the way to expiration and this has not been called away, okay, you can go all the way through to expiration and this not be called away. If you don't clean this up, meaning if you don't close this trade and we're above $60 by a penny, the broker has no choice. Remember, what we're trading here is contracts. No, you do not forfeit the short call. Anytime you sell premium, that's yours to keep, unless you buy it back, Mando. They can't take it back unless you buy it back, and I'll explain that for here in just a second. But in this circumstance, if you don't close this trade prior to actual expiration of the position, well, the broker has no choice, because you gave someone in the market the right to buy the stock at 60. Okay, so if it hasn't been called its expiration day, you want this contract to go, you want to clean up this trade, you don't have to pay anything to get out of this trade. You just let it expire. Okay. And what's going to happen by Monday morning is you're going to get a notification that you owe somebody in the market. The options clearinghouse is going to assign this to somebody. They buy it for $60, and all you have to do is take your 50 strike contract, exercise it, and the stock goes out at $60. You keep the $10 plus the $1 that you collected for premium on that trade. Okay? Make sense? Now, I know this might be a little bit deep for a lot of people, but it really isn't that hard when you look at an options chain. Let's say we were taking a look at a position here. I've got Moderna on here, but let's use something else. Let's take a look at Exxon Mobil. I've got an alert on Exxon Mobil, and it hasn't triggered yet, but I'm watching this potential here for this to push up an alert and maybe a long position that I want to be thinking about after breaking through this resistance in the trade. So if I were to look at Exxon Mobil here and I'm thinking I want to take a debit spread, well, first off, there's a couple reasons you might want to consider that. First is the cost of the trade. Because if we come down here, maybe you don't really want to have to come up with, $785 for the trade. Okay. You could buy this option. Okay. And I always trade anytime I'm doing any long position. I'm always going to be somewhere between 70 and 80 deltas, and I'm looking for good, strong open interest. So I've got a beautiful open interest here on this trade, which means I'm not alone in thinking Exxon Mobil could be bullish. Okay, that it may be ready to go. There's a lot of folks trading this to the long side thinking it could go up. So I pick this option up, and I want you to notice in here it's got a delta of 3. Excuse me, a gamma of 3, a theta of 4. Okay, the delta is 71. That means this is expiring at 4 cents a day on average. Okay. BD, yes, if you bought an option at $60, a call option at $60, okay, on that trade, meaning that you picked up let's say I sold the 60 strike option and you happen to buy it. If the stock is above 60, then all you have to do is exercise your contract. You exercise the contract, and I'll be notified by the options clearinghouse that, well, the options clearinghouse notifies the broker. The broker says, hey, Campbell, you've been assigned. BD wants this stock. I just exercised my 50 strike option, and I'm out at 50. I bought it at 50. You bought it at 60 from me. I make the $10 difference plus the premium that I picked up on the trade. Okay, so any short strike that is in the money can be exercised by the holder of that position. Okay. No, it doesn't matter, because if they're paired together, BD. Okay. If you go in to the weekend and you're still holding the long 50 strike and the 60 strike option is in the money, okay, if you don't clean up that short strike in there, it doesn't matter that your option expired. Okay, it doesn't matter, because what they're looking at on that 60 strike option is you sold someone the stock at $60 a share. Okay? You gave them the right to buy it at $60 a share. And all you're going to have to do is exercise. Okay? Now, I wouldn't do that. Okay? You don't want to put yourself into that position. If you want to continue to hold the long strike or stay with the trade, then what I would do is just at the end, or when it's coming close to the end, is just go buy it back, because all of the time has faded out of that trade, right? Hey Tom, how you doing? All the time will have faded out of that trade. All the premium will be faded out of that trade, and you can buy it back pretty cheap. Okay? If it's out of the money and coming toward expiration, I still just go in and close it. I just buy it back. I may have to buy it back for a penny or two, but then I remove that risk in the market. Okay? You don't have to buy it back, but I often do if there's any risk of that being in a position that I don't want to be holding. Okay? So in this example, I'm buying this January contract here for Exxon Mobil. I'm paying $7.85. I have theta decay of 4. All right. Now, I'm going to come out here and notice that all I've got is a choice, is a 35 delta or an 18 delta. That 35 delta is pretty close. You can sell it in the trade, and let's see the results of me selling that. If I put these two trades together, okay, I'm on an Analyze tab here. Let me go to the Trade tab, actually, because then I can show you the actual figures here. We're going to buy this one. We're going to sell this one in the trade. If I confirm this trade, it says that I have a max profit of 438 on the trade and a maximum loss of 562. Now, I typically don't want to trade like that. I don't want my loss to be bigger than my potential gain. But remember, I'm going to have a stop loss in this trade. So let's follow this through with this potential stop loss. And notice in here that this is decaying at 3 cents a day. Okay, so in this situation, I have flattened out my theta decay to just a penny. Okay, these are both going to decay at basically the same rate. Okay. So if I put this over here on the Analyze tab, whoops, I didn't want to do that. There it is, risk profile. That's what that profile that I drew out for you is, a debit spread. And by the way, it looks very similar to a bull put credit spread. It's the same profile for a bull put credit spread. It's the same profile basically for a fig leaf or a poor man's covered call. It's just, and it's the same as a calendar spread. The profile is just by using different months. Short strike. Okay, exact same profile for all of those. Now, if we go back to the chart, would you guys agree if I bought this trade, my stop loss should be down here someplace? That would be a logical place for my stop loss. So let's call my stop loss 118.50. Okay. So if I look at this trade, my max risk, it says, is over $500, right? $562 for my max risk. But if I put in a stop loss at 118.50, if I go to my Analyze and go over here to 118.50, if I were to stop out there today, which is the pink line, it would be today. If I stop out there today, my maximum risk is $67.52. So I've lowered the risk on this trade pretty dramatically. And because I brought in $2 in premium. If you look right here, the trade was $7.85. I collected $2.12, lowering my entry cost to $5.62. All right. If I were to change this trade just to show you the long call option here, and I do the stop loss, we're going to analyze this trade. If I do the stop loss at 118.50, I'm going to lose $129. Okay. So by putting in that short strike on this trade, I have lowered the risk to my overall stop loss on this trade by almost half. Gotta send it over there. So 118.50 is almost half of what it would be if I just had the long call option alone. Okay. After the ex-dividend date, or when you're coming up on the ex-dividend date, there's a lot of people that get really freaked out about that. And honestly, it's not that big a deal. In the thousands of these that I've traded over my career, that's almost never caused me any problem at all on those positions. It almost never causes me a problem on those positions. Okay, but you do always want to pay attention to a dividend, and particularly if it's a special dividend, like it's a special dividend that's paying this really big premium. Okay, then you could have some risk on the trade. And that might be one reason why you might get called away early. So for example, in this situation, if the stock did rally up to 125, it's just barely in the money, but there's a big dividend coming, you could understand how people might execute this contract to become an owner of the stock prior to the dividend, to the ex-dividend date, so they can collect the dividend on the position. And it kind of sucks when that happens, an early expiration, but really it doesn't matter. You are willing, if you sell this strike here, you have to be willing to let the stock go at that price, because that's what you've done. You've signed a contract that gives someone the right to buy it from you at 125. Okay? So here's the key thing, and people always get confused about this. We sold this option here for $2.12. Okay? If the stock goes above 125 and you're executed on the trade, okay, you still keep the $212. They can't take that away from you. That's you. They paid for that right. They paid you for the right to buy the stock at 125. Now think about that, guys. What is the downside to buying something low, giving someone the right to buy it at a higher price, and they take it away? Isn't that what we want to do? And instead of paying a commission or anything like that to close the trade, I don't have to do that. Okay? If they want to take it up here, I'm more than willing to let them take it. Okay? Because if I'm buying a good price pattern in the trade on a trend, my entry here, if it's stretched up here and they want to take it, take it. Because I'll just look for that opportunity for it to rest or pull back and buy it again. Yes, you can close out a short strike anytime you choose. Okay, so say for example that 212 that we sold this for, that 212, the stock hasn't moved enough. It's moved up, but you've got a premium on your long strike, but it's getting close to expiration here on this trade. And this option, let's say it's 3 weeks to expiration, and this option that you sold is now only worth $100. You can buy it back. You collected 212, you buy it back from $100. You've made $112 on that trade. So you can buy it back at any time. You can buy it back at a loss if you choose to, but I wouldn't do that. Okay, because when you buy it back at a loss, you end up adding cost to your overall trade. We bought that trade for $7.85, and if we take a loss on this, buy it back for a loss, we ended up just adding cost to the entry of this long trade. Now we've got to get more upside move in the trade just to break even. Okay. Sell it at a premium. Now, I'm going to show you what I think is why I don't actually consider myself a big debit spread trader, because the technical terms of the debit spread is you do these trades all at the same time. Okay, so let me ask you guys this. If we're looking at a trade and this is the proper time to be a buyer, okay, we've got a good buy signal going on here, and this is the proper time to be a buyer. Is this the best time to sell that option? It's usually not the best time to sell that option. We want that to move up, then sell that option, because we'll make more money. for selling that option. So it's legging in to a debit spread. Now, the reason people have trouble with this most of the time is one of the reasons they trade the debit spread is because they can't afford the trade anyway. So, you know, in this particular situation, it was $786, okay, that it was going to cost us to get into that trade. If you truly can't afford that trade on its own, you shouldn't trade this at all. Even with selling this call option, if you sell the call option to make this one cheap enough for you to be able to afford, when this stock goes against you, you're going to panic in the trade because you've got too much skin in the game and you're not really sure what you should be doing with it. Okay, it can still, it can cause traders to overtrade their hand, meaning that they think they got this really good sweet deal in here, but that stop loss still is too big because we really couldn't afford that position to begin with. Okay, so I prefer to leg into the trade when I can find those good entry points. And you guys know I use the pullback opportunity. That's that pullback to the trend. The stock has been trending, or the pop out of the box pattern where we've got this nice tight consolidation in here. And I look for that pop through. I look for that to stretch up. Then I sell it. Okay, that gives me more space to the upside and I get more money for the short strike. Okay, so instead of this being at 125, heck, I might be up here at 130. I got more money for the trade selling it up here, and I gave myself another $5 for that to potentially move up. I just made more money on the trade. And if I want to hold this trade, as that stretched up, this rests back, expires, hedges the pullback in this trade, I can close this for a profit and just be ready for the next upside to come in that pattern. Okay, so you can move in and out of these positions. Now, technically, the debit spread has to be done in the same calendar month. Okay, if it's in a different calendar month, they call the exact same trade a calendar spread. Okay, and if you've ever heard of the fig leaf trade or the poor man's covered call, you can do this over and over and over for different time frames, and the mechanics are exactly the same. By understanding the debit spread, guys, you've got the tools in here on that risk profile that this could be a covered call, poor man's covered call, or what they call the fig leaf. You can do the calendar spread, the debit spread, and it even gives you the potential setup for a bull put credit spread. Okay. So what are the advantages and disadvantages of this trade? That works exactly the same way on ETFs. Exactly the same way. The one problem that you have sometimes on ETFs is there's just not a lot of money in them. Okay, so if we were to look at XME, whoops, how did I get the 10-year? Wow. If we look at XME, I don't know what month you'd be thinking in here, but there's not going to be a tremendous amount of premium in some of these trades. That it might still work. Okay, so XME, look over here, maybe we buy this one. Oh wow, no, I wouldn't trade this at all. Look at these bid-ask spreads. Now maybe they've messed this up for the close today, but I would have no interest in this at all for options. If live trading is this wide, no interest in this at all. Unless I own the stock itself. Okay. Bid-ask spreads are ridiculous on this thing. But if you use, let's say you use something like something very liquid like GLD, it works just the same. If we're long a position in here, we would go out, find something out here that has a high probability of expiring. And I usually like to go out here around the 30 deltas for my short strike. I could sell this one here on the trade. And this would be more of my preferred. Because when I do it that way, first I'm using the delta in my favor. I've picked up a delta long with 70 deltas. 70% chance of still being in the money at expiration. I've sold a 30 strike option with a 70% chance of still being out of the money at expiration. Okay. In doing that, I've lowered the cost of my trade here by quite a bit. I've lowered it by $2.61 on that trade. And I actually have a position that has a favorable win-loss on it. My max loss being 652 by max gain 848. Okay, so I'm actually have that potential. I can make more than I could potentially lose. Then I figure out where my stop loss is to protect the whole trade because I don't want to lose 652. I want to base my my trade off of those positions. Okay. Now the other thing about these trades, guys, that a lot of people get concerned about, and it's probably because they just don't know on these, is that on a trade like this, I can close both of these at the same time. So at any point in time, if I'm happy with the profit on this, this is up $350 in profit. I just make one order and close both of these trades at the same time. Okay. I don't have to, it's not a big complication. Both of them go out at the same time. Okay. So close them both down at the same time and you don't have to worry about it. There are some circumstances when the market gets wild or volatile that the bid-ask spreads widen up a little bit and you may actually be better off closing them one at a time. But 90% of the time I just right click, close position, close the whole trade. Okay. How many days out do I get? Well, one of the rules I have for trading is if I'm thinking directionally long on a position, anytime I take a directional trade, I usually want to have 60 days plus. Now the reason is because with 60 days plus, if this has to rest, see how this is away from trend here? If this has to rest over to here, if I have at least 60 days, I can handle that resting pattern here before it takes off. Okay? If I go too short a time frame, too short on those contracts in time, theta decay is eating me alive. And I don't know if you guys have ever had this happen to you, but it's happened to me before. I went too short in time. And by the time the trade takes off, there's no way I'm going to make any money on it. I've lost too much in theta. Okay. I planned the trading correctly. So anytime I'm thinking directionally, at least 60 days on that trade. Okay. Loaf, if you're doing a directional long position, okay, if you're doing a directional long position, say you're taking this long, but you sell a bear call spread above up here, yeah, I don't have a problem with that. You're not going to get as much offsetting theta in this. But let's say, for example, you buy Exxon Mobil in the stock and you can only afford to really buy 20 shares. With 20 shares, you're essentially doing the same kind of thing here by putting a credit spread up here. You're hedging that upside position with a credit spread. And I've got no problem with that at all. You're just not going to get the same benefit of theta. And you're not going to get as much cost lowering of the entry price when you do. Okay. Eduardo, I really don't have time tonight to explain to you conditional orders, but there are videos on my YouTube channel for conditional orders. And a conditional order is I can take, if I'm long this contract and short this contract, I can have one trade that says if the stop is triggered here, close both trades. If the stock falls into here, both options get sold. Well, that's not true. The position is closed. One is sold, one is bought. All in the same trade. One trade. And it's a conditional order. And I use them all the time on Thinkorswim. I mean all the time. I use debit spread like trades, Sue. And when I say that is I'm usually legging into them. Okay. Legging into that position. So if I get any move in the stock that looks like a bullish entry, I can enter that trade. And then if it moves, then sell the out of the money, and I'm legging in to the debit spread. Yeah, if you're actually doing what I'm just talking about now, Loaf, is you're legging into that position later, I got no problem with that either. That's what I like to do. Sure. We all know that when we get into a trade, okay, if we buy an option in here, if you'll notice this 70 delta option, theta is 6 cents a day. Okay. This, whatever we paid for premium on this trade, if I change this column here to extrinsic value, what we know as a fact in every trade is if this trade doesn't move, we're going to lose $480. Okay? Because this much premium that we have paid, that's above and beyond our intrinsic value, will be zero at expiration. It doesn't matter if you're in the money, out of the money, whatever. Whatever you paid in premium, 60 days from now will be zero. It has to be. Okay? It will always be zero. Win, lose, or draw on the trade. At expiration, everything you paid in premium goes to zero. Okay? So, if this is working against us, if we sell this one out of the money, this 34 is decaying at 6 cents a day as well. Okay? But this one is decaying in our favor. Yes, you're getting decay. That's correct. So in this situation, I have a theta neutral position. I've canceled my theta on this trade. Now, because these are in the same month, these are going to expire at about the same rate. You get a little bit more expiration in here the closer you get to expiration, because the probabilities of this one staying out of the money grows faster than this one falling out of the money. Okay, so typically this will accelerate to a point that it will overcome the theta decay here. Okay, but it won't ever overcome the whole amount, because we paid $4.82 for extrinsic value. If we sell this here, the maximum we're going to get back is $3.10. Okay, does that make sense? But they are decaying at the same rate, so it gives me a good 30 days easy that I can wait on the trade. It doesn't move very much. I can wait, but my theta is not costing me anything. Like a stock trade, if I buy a stock position, there's no decay. I can hold that thing forever. As long as the stock doesn't go down, I don't lose anything. What I've done is turn this more like into a stock trade, because there's no theta decay here initially. And as time passes, this theta will overcome this theta, meaning that I could get more premium decaying than I'm decaying here. Okay. And that's really one of the advantages of a calendar spread. A debit spread looks exactly the same as a calendar spread. They're just in 2 different months. Calendar spread is if I bought this option, okay, I'm going to buy this option and then go to the December contracts here with 32 days, and I'm going to sell that out of the money contract here at 32 deltas. As you can see, this is decaying at 7 cents a day. And this will expire before this does. That's a debit spread, okay? Or excuse me, a calendar spread, because they're in 2 separate months. And this one will expire in 32 days, where my longer trade is going to be 60 days out. Does that make sense? And that's really the only difference between a debit spread and a calendar spread. Calendar spread is in different months, and I can actually get more theta decay by going to the shorter term. Okay. You guys are all familiar with the theta decay chart, how theta accelerates to expiration. So if we have a theta decay chart, theta actually decays kind of slowly at first, and then it goes parabolic at the end. This is expiration day here. In that last 2 or 3 weeks of that option, the theta decay ramps up and accelerates to the downside. So if I have an option up here that's 60 days to expiration that I'm long, and I'm short this one, I've actually put theta decay in my advantage. That makes sense? Yeah, if you sell a different month, it doesn't matter. A different month, and usually the shorter term is going to be your short strike for the calendar. Okay, here, let me show you. If I'm going to, what was that we were just looking at? Gold? I don't remember. Doesn't matter. If I go to the January contracts here, and I do this trade, buy the 70, sell the 30, strike option, 30 delta option, 70 delta, sell the 30 delta. on this trade and I put this over on the Analyze tab, that is a debit spread. Okay? But now I'm going to change this up and I'm going to buy this contract here, same contract, buy that contract, but I'm going to go to the Decembers and sell the 30 delta option out of the money. Come on. I'm going to sell this one. Okay. Sell that option. If I go to and analyze what this trade looks like, it's basically identical. The only thing different is because I have two different theta decay rates, I get more of this little sway. Instead of that nice straight line, I get this little sway in here. That's the only difference between a calendar spread and a debit spread. They're essentially the same trade, just different months in the position. Okay? Now, both of these trades, the advantage of these trades is to lower your initial cost into the trade. And it's also an offsetting of your theta decay. Whether it's a debit spread or a calendar spread, it's going to minimize the theta risk on the trade, lower your entry cost into the trade. Okay? But the downside is it caps your upside profit. Okay? If you get into this trade at the right time and that thing just gaps and zooms to the upside, doesn't matter. If it goes past your long strike here, you'll never make any more money on the trade. Your trade is capped. That's as high as you can go. Okay? So that's one of your downsides. Another one of your downsides is that you risk being called on the trade. If you're above here, if you're above your short strike, you risk getting called away at that price. And unfortunately, people will panic about that and they'll make really bad decisions around it. Here's something I would say. If you sell that out of the money call, make sure you're willing to let it go at that price. Don't fight that. If it goes up there, isn't that what we want? We want to buy low and sell high. Here we bought low and somebody paid us to buy it at a higher price. Don't panic about that. Right? Isn't that what we want? They paid us to take the stock from us at a higher price. That kind of sounds like a win-win to me, right? So don't panic if that occurs. It's no big deal. Don't buy it back in panic. Oh my gosh, I'm losing money on the short strike. Don't do that. Because remember, as soon as it's called, as soon as they call that trade, you get to keep all the premium that you sold it for. And you get the strike price for your stock. So don't panic about the trade. Now, I know this can kind of be complicated here if you've never done these before, guys, and I really want to recommend that what you do is you start practicing. You can see I really utilize Thinkorswim, and it's something I do on every trade. If I'm looking at a position, if I'm looking at Exxon Mobil, I actually look at the chart and I lay out that trade. Okay? If I want to be in this position, I know that I want to be somewhere between 70 and 80 deltas on the long side. Okay? And then I look for my short strike. Where do I want it to be? I don't have to buy this one or sell this one. I can actually go to this one. Clearly, I don't make as much money on the trade, but I have less risk of being called away. That takes that all the way up to 130. It lowers that 785 down to 686. But now I have a trade where I could potentially make more than I'm risking on the position. Okay. And then if I stop out, all I got to do is put this over here. Oops. Let's see, which one did I just do? This one is no longer there. Okay, get rid of that. My 118.50 stop loss is right here, and I can look right in there and say, okay, I'm going to lose about $94 if it stops out there today. I'm okay with that. All right, I don't plan to hold this all the way through to expiration. The expiration, if the stock is still right there at 118.50 and I haven't closed this down, my max risk at expiration is 340. I don't want that trade. Obviously, if it hasn't moved in 60 days, even long before that, I'm going to be closing that trade down, right? But I've reduced my risk to that stop loss because of the short strike that is expiring in my favor. So I've lowered my stop loss risk on that trade by having that short strike. Okay, does that make sense? Now, what I want to ask you guys is if this stuff is a little bit of a struggle for you, Ed's been posting, a link. We're doing a $7 trial for 30 days. I mean, seriously, guys, you can't even buy a burger for $7 anymore. Then I think it costs more than $7 for a Big Mac, for crying out loud. And you can be in the trading room for 30 days for $7. Anytime this comes up, you can ask me to take a look at it, and I can go lay it out. And what I want to suggest that you do is when you do that, don't trade this live. Put it on a paper trade account and trade it. Trade it and trade it and trade it and trade it and practice it until you understand it. Until you could really do it in your sleep. And trust me, you go through a few of these, and all of a sudden it's just gonna click. You're gonna go, okay, I get it now. That makes sense. Okay. I work really hard in Right Way Options to teach people the strategies that can give them far more tools to be successful in the market. Okay, not just directional long and directional short. Those are the highest risk trades that you can do in options. Okay, but if you truly understand the power of options, how you can use them in combination, you can reduce risk, you can enhance profit, you can lower risk to stop losses, you can make trades pay you over and over and over if you really understand the power of options. Okay? So if this was interesting to you tonight, and I'm going to stick around and answer some more questions if you have them, but if you found this interesting, guys, because this $7 trial is not going to last. We're going to put it back up there. So get it now. I mean, you're not going to get a better Black Friday deal than $7 for a full 30 days. And I do 2 hours of education every day. Trading room. Ask me anything. And you can follow the trades that we take. Okay? Well, I had mentioned on these, Carrie, that the pros of this trade is it lowers the cost of entry. It offsets your theta decay in the trade. But it comes at a risk of capping the potential profit in the trade. You could be called away on your position in the trade. And you still have to manage the position for a stop loss. You can't forget the stop loss just because you have on a multiple trade. Okay. Now vertical spreads, and this is a vertical spread. It's just this is a vertical debit spread. Okay, if I were to trade Exxon Mobil here for a bull put credit spread, it's going to look the same, and it's also going to be called a vertical. So if I were to trade this trade right here, that's also a vertical, but this is a credit spread. And if I put that over on the analyzed chart, guess what? Looks the same. The same trade. It's a bullish trade. This has less directional effect than the debit spread. If I'm taking a directional long position, I have to be more biased to the bullish side. I want to be very bullish on that trade. This trade is somewhat bullish with a neutral part to that trade. I don't care how much it goes up. It can stay right where it is, and I can make the max profit on this trade. It doesn't have to go up. As long as it doesn't go down, okay, this can expire and I can collect the full premium on the trade. Okay. So it's the same type of, we're still bullish, but instead of aggressively bullish, we're more neutral on the position, and we can get the same effect for the same stock move. This is going to have a little bit more of a controlled risk, meaning that this is a $5 wide, so the maximum loss on this trade is $5 minus your credit. Okay, so it's a little bit tighter risk parameters, but this trade has a potential of losing more than it can ever make. Where the debit spread is going to have the potential to always make, hopefully, should make more than you could potentially lose to your stop loss. That makes sense? And I know for a lot of folks, I'm going really fast tonight on this kind of stuff. I know there's some folks in here, their heads starting to hurt, smoke's coming out of their ears and stuff like that. Please, I want you to understand that that happened to me as well. I didn't come by this stuff easy. I really had to work at this. But I'm also telling you, it's worth knowing. Okay, when you really understand the power of options, you'll never look at the market the same way again. You can handle the risk. You know how to offset your risk. You know how to control your risk. Trades. And it's worth knowing. All right. So I would look into the debit spread. Remember, what we're trying to do here, what I'm trying to do tonight, is give you another tool that you can attack the market with. That you can exploit the price action of a chart with another tool that's still directional, lowers the cost of the entry into the trade, and flattens out your theta decay. It gives you more time to be in the trade without theta getting into your pocket so much. Okay? And if you can add that tool to your arsenal, you're going to find there's a lot of times that you'll look and say, well, instead of just the directional long trade, maybe I do the debit spread. Or maybe I go ahead and get in the directional long trade, let it move up a little bit, then enter the short strike. Leg into the trade to offset the risk of any pullback. Lowering your position, lowering your risk in your position. All right? Any additional questions? So guys, I really want to encourage you, for $7, come on over. We'll spend a full month and you can ask me any question on this stuff. I can go over it 100 times Well, probably not 100 times in 30 days, but I can go over it and over it and over it so that you got it. Okay? You understand the trade. And believe me, if you learn this trade, you'll understand the covered call pretty quickly. You'll understand the calendar spread really quickly. And all of them are, you know, people will ask me all the time, what's the best option strategy? The one that works for this setup is the best one. The one that fits you and works for this setup. Every option strategy has a purpose. Okay? None of them are better than the others. It's how you apply them to the trade and the risk reward scenario that you want to play out in the position. Okay. Any other questions? You guys are pretty quiet tonight. Oh, you're welcome. Thank you. Thanks for being here tonight. I really do appreciate it. Hope this was useful to you. Hope it made some sense. It is recorded, RM, yes. And I'll try to get it posted to the YouTube channel as soon as I can. Yeah, thank you guys. I really appreciate it. Take advantage of that special. And I hope to see you in the trading room tomorrow morning. Everyone take care. Have a great evening. For RWO, I know I'll see Larry tomorrow. Y'all take care. BD, thank you. You're welcome. Thanks, Loaf. Have a great evening, everyone. Wish you all the best.